Okay, thanks everyone for coming. I know it's evening for some of you, morning for some of you, so thanks for coming. It's midnight from where I am, so I may be a bit tired, but we're gonna power through. Okay, so today thanks for again coming. I'm just gonna give a brief introduction on myself for those of you who don't know me, and then I'm really gonna get into markets because I think that's why a lot of you are here today. I want to hear my thoughts on what's happening in the market, and for good reason. I mean, everything is red. It's kind of crazy. But yeah, um, I hope my insights will prove some kind of use. And just remember, this is not financial advice. Do consult whoever you need to consult for this. And yeah, let's get into it. Okay. So those of you who first time to my webinar or conference call, investor call, welcome. This is my profile. This is who I am. Yeah, I have all these credentials, and at the end of it, I say none of it matters. And this is kind of true because I was kind of reflecting on this when I was preparing today's presentation. I know a lot of smart people who have lost a lot of money doing very stupid things in the market. So some of this really doesn't matter. Like, if you guys know long-term capital management, that was a huge blow up, but had the most IQ ever assembled in like a very small fund. So really none of that matters. Okay. So the way I trade and the reason why I trade, my passion is because I'll get into that. This is just my credentials. And then of course my full-time job or my other job is I'm actually an investment director at a asset manager. So that's my other job. Okay. Yeah, so this is why I do eToro. So for you guys that don't know, this is the origin story. Um, when I was younger, my dad unfortunately passed away. And what happened was that I found out that when I went to the market to look for advice, I couldn't really get any. Like everybody was trying to sell me something. And I didn't like that. I felt that, finance kind of needs to do better. And so I started on this eToro journey because, finance needs to be better. Um, I find that it shifts a lot of responsibility from the industry itself back to people. They say, oh, this is not financial advice, this is historical, blah, 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 blah. And then, of course, after that, they try and sell you all kinds of things. It doesn't make sense. But I think eToro really has the power to change this because you yourself as an investor, you have to invest. You have to put your own money down. And secondly, you cannot lie about historics. There's a trick in the industry. What they do is they put out 5 different strategies, and at the end of 5 years, they show you the best performing one. They say, hey, this is the best performing, slightly do better in the future. Of course, that isn't true. So then they just do that every time and just keep selling you different things. And, it's not nice. But I felt, if you put your own money, your own skin in the game, it changes a lot of things. So of course this is all fine and dandy and sounds very fantastic, but like how do I prove that I'm being honest about all this? Oh, sorry, this is a picture of my family. So this is my mom and my dad. Yeah, it's a long time ago because my dad passed away quite some time ago. Okay. Yeah, so this is actually how I prove to you guys that I know what I'm doing and I'm honest about what I'm doing. So I show evidence of knowledge because you have a track record. I just mentioned that skin in the game. So I invested some of my own money in it. As some of you know, it's about 75-ish thousand dollars. It was 80, but after the recent market correction, it came down to 75. And of course, I do have a lot of stuff out there, which is like I write articles on Seeking Alpha and things like that. So you can read about it. And of course, I do webinars like this and investor calls, and I publish them publicly. And all that just basically says, I know what I'm doing. And also, I really can't stand the selling that goes on in the finance market. So if you don't ever hear me talking about how great my returns are, that's kind of on purpose because I kind of think that's rubbish. But yeah, just me. I'm a yeah, I'm a very plain person. Like, okay, so get into it. So yeah, these are things that I define as important. So I present this at every call. I also want to make sure that when we do investments, not only do we shift responsibility away, I want to take people's minds off things. If you're good, I work in blockchain and crypto. What I see is there's a lot of developers who are very keen on trading because you're in crypto, right? And they start diverting a lot of attention away. It takes away attention from the actual work. Even though they're not good at it, they don't love it, they've never studied it, they just get so caught up in it. And I also don't like that as well. So I really believe everybody's good at what they are doing. Their full-time jobs, they have a passion, and that's not necessarily finance. Some people just don't like finance. You can't find somebody to trust, and that's why I'm here. This is what I'm trying to solve. Um, I don't think it's, and I know this is very controversial, but everyone wants to see green months. Like your portfolio goes up and up towards the right. It's just not a very practical thing in finance, just because that's what markets are. I also don't give expected returns because I think that that's very hard to judge. Mainly because you don't know which part of the market cycle you're in. And of course, things can take a hit. So it's difficult. But at the same time, I understand that people need some kind of number in their head to say, oh, I want this amount of return every year so I can plan for my retirement. I think that's a very hard thing to do. And I don't like giving people false hope. But if you have to, you probably what you can do is look at a 60-40 bond portfolio, stock and bond portfolio. It gives about 13% a year. I think that's a decent gauge. It's not great, especially based on historics. And coming into the next few years might be difficult. And I'll get into a little bit about why that is later. But yeah. And also, if you notice my portfolio, it tends to be very contrarian. I don't like following what the market likes. I don't buy like Adidas and Nike and stuff like that. Or I don't, I'm a very weird person, so it's very hard for me to like understand like cool brands. Like everybody's into Tesla. I really don't like Tesla. I don't know why. So I'm a nerd. I love tech. I love finance. These are the two things I love in life. So I just base it based on what I know, and what I know is numbers and facts and figures. Okay, so I'll get into that. Okay, so I don't want to get into this a little bit because given the market circumstances we are in, so I get this question a lot, like why did I choose macro out of all the styles that are out there? It's not because I've seen like value investing and I've tried different short, long up short and things like that. What it is really because I noticed the assets that are available on eToro, they're very different. They are not traditional assets which I would have as a fund manager. In fact, in my position where I am now, I cater to a lot of high net worth individuals. The assets that we have and the number of instruments we have is just different. And there's nothing wrong with that. Like, I don't think you want eToro to start selling options. There's just, it's too much, you know? So the game is very different. But what you can see is that in the last like 30, we call it the 30 track record, which is 30 years of 30% performance. And by the way, that's not possible anymore, I think, given this day and age. But basically, it was only Soros and Buffett. So one was a value investor and one was a macro guy. And given that, if you look at the beautiful people on the right here, just take a second. It's like, okay, do you guys recognize any of them? They're all famous investors, by the way. So just take a second. I'll have a quick glander. Okay, so of course everybody knows Warren Buffett, the gentleman on the right, the Oracle of Omaha. Everybody knows him. The other three gentlemen you will not know, but they're also known as the Warren Buffett of Australia, or Warren Buffett of India, and the Warren Buffett of Japan. The reason why you don't know them is because in their respective countries, they may not have done so well. So their profits are just not known of. It could also be country bias and things like that. But they basically didn't perform as well as the Oracle of Omaha, even though they used the same tactics and the same techniques. So having understood that, I was like, okay, I can try and copy value investing as a whole, but it's a bit difficult given the countries and the selection and the time period we're in. It might be a bit difficult. And also, Warren Buffett, he's known to hold a lot of cash, but he's also known to write put options, which we can't do, unfortunately, on eToro. Again, we don't want to do it. I think, sorry, call options. And of course, we don't want to do it. But because he's a value investor, he sees the value, he's able to optimize his capital expenditure and all that. So that's kind of why his returns have been so great. But yeah, I don't think it's very it's hard to replicate. So I've chosen macro because of those specific reasons. Okay, and also this is interesting because I shared this the other time. Like on the left, you see this in Matt Faber. He's one of the very famous quants in the market. He has a great podcast. If you guys ever have a chance to listen to him, so he says in 2010 they nominated the best fund managers of the decade. So the best fund managers in 2000 and 2010. And the number of people who have outperformed in the next 10 years from 2010 to 2020 is actually zero. And this is yeah, you can read that. The top 5 average performance was underperformance of 5% per year. So if the S&P did 10, they did 5. And the winner was 8 percentage points of underperformance per year. So if the S&P did 10, they did 2. So what's the reason for that? I also believe it's a stylistic thing. And this is a very difficult thing for people to accept as well. I don't question that. In fact, this is a video I did a couple of years ago. The number one reason why we'll make money on eToro. It has more dislikes than likes, if you guys notice. Because it's a very difficult message to accept. And I don't think many people are going to accept it. But my belief is that if I follow this style, I try and adapt to the different timings and the different economic scenarios we're in, I would do a little bit better than everybody else. So if I go back to one of my slides, I said that I think I'm about 5 years too early to do this full time as a professional and to really shout about my message about what I'm trying to do. One of the reasons is actually because I've only got a 5-6 year track record. I think it's too short. I need at least 10 years to really prove to people what I'm doing is legit. And my goal is to be the number one popular investor, not in year 5, not in year 10, but in year 15. So I do need a very, very long kind of data set to prove this. And I mean, of course it's different, but I do want to be even better than people you can find on public.com and stuff like that. So across all platforms, I do want to be the best at year 15. That's the goal. Okay, so having said that, okay, I shared this in my previous investor call. I don't like and this really getting into the markets and the reason why a lot of you are here today. The market's falling, like everybody knows that, and it's been very volatile recently. We saw some optimism last Friday because inflation numbers were terrible, but the market still went up. It touched all-time highs and things like that. But I've always been very cautious of the market, and the reason for that is that you can see there are different structures in the market right now. So there's a lot of passive flows, there's a lot of ETFs in the market, and that means that ETFs are very, very straightforward algorithms, right? I give you money, you buy. That's kind of it. It doesn't have any, okay, it falls 10%, let's go in and buy some more. There's none of that. It's just, I give you money, you just buy it. It's very, very basic. But because of that, because of all these passive flows, when the market falls, is there anyone to pick it back up? As of recently, of course, there always was. Everybody says buy the dip. And for a very long period of time, this has been true. And I've benefited from this a little bit, but not to the extent of everybody else. And now we're getting into a bit of a loony scenario because gamma flip is really when you take options and the market falls by a certain amount, it will fall even faster because of this concept, what we call gamma flip. You can go read about it. I don't want to bore everybody. Reopening trade is dead. So I shared this again 3 months ago because I said that in Singapore, we have the highest vaccination rates in the world. One of the highest, but we're still like, was 3 months ago, we're completely shut down. We could dine out in groups of 2, basically. And now we only can dine out in groups of 5. And I'm mask on basically every day, all the time. Even in office, I have to have my mask on. But the markets are still higher. It's like, even with the shutdowns all around the world, with the supply chain issues, we are still at all-time highs in the stock market. That doesn't quite make sense. I know some of you are going to argue money printing and all that, but I'll get into that a little bit. And the last reason, of course, is Ralph Hall did a really great video. If you guys ever have a chance to watch that and read into his research, he's just basically saying a lot of people are retiring. There's a retirement crisis coming, so you need to be careful of that. Okay, so that was my outlook 3 months ago. Has it changed today? The answer is no, it has not. And I know a lot of people are very anxious and worried about the market, but I do want to assure you that, hang on, oh, sorry, I should go and get into, which part should I get into? I'll get into this part first. So do we know where the market's headed? The truth is we do know where the market's headed. We don't know the timing and we don't know the catalyst that caused it. But if you look at Ray Dalio's research or what he's done in Bridgewater Capital, which is the biggest hedge fund in the world, by the way, he did this great video on how the economic machine works. So what he's saying is that basically any economy can only grow in one of two manners. For the long-term horizon, that is productivity, so it needs to grow up. And the other short-term debt cycles are really debt, is credit-based. And those are the only two ways the economy can grow. Usually what happens is that productivity cannot keep up, debt increases, which is where money printing comes in, and then the average household will start accumulating more and more debt. And then what happens is that it needs to come to a point where it needs to be leveraged. that normally happens when things like inflation kicks in. And we are experiencing that now. We are experiencing inflation. But why hasn't it happened so long? Uh, why hasn't it happened recently is because I think there's a lot of productivity growth as well. But now, because of COVID, there's been less productivity growth, but there's been more credit. So that could be why there's inflation. And also, there's another concept because if you think about capitalism as a whole, and this is a structural capitalism, nothing wrong with it. The rich will always get richer. If capitalism is defined as people who have capital will continue to generate more capital, and that's just generally the way it works. It's whether that's good or bad is not. It's too philosophical and too difficult for me. I'm not smart enough to go through that conversation. But I'm just saying, the rich are getting richer and the poor are getting poorer. And when that index reaches too high, there comes problems as well, social problems. And I do believe we are seeing a bit of that in today's day and age. So is that good or bad? I mean, it's part of the cycles. So what we're seeing now in the market is really a very high debt. And then what's happening is we're coming off the debt. So that's why we're talking about tapering. I think today, after the Fed meeting, they're going to talk about it. We're going to do rate hikes. It's going to come sooner than expected. I do expect that. And I'm positioned for it right now. I'm not, of course, I'm not all stocks and not all whatever, but I'm very heavily in cash. And I can show you that guys that later. Okay, so I always take a very conservative approach to the market. And I do, if you guys been following me since like 2017, 2018, I actually did very, very badly because I'm always very cautious of the market. Like I'm always worried that it's going to drop. And there's a reason for that. I just want to share this with you guys. So I actually started trading in 2018. So this is, hang on, yeah. Oops. So 2018. So this is during the period where I started trading. So you guys can see here. This is really during the 2018 financial crisis. So it dropped this much, right? This red line is roughly when I opened my account, thereabouts, right? And it dropped 58%. And that was terrifying. Like I saw a lot of people lose a lot of money. And that's when I started trading. And I also saw really mass just retirements just going away. And that really left an impression on me. And most people who trade nowadays have never really seen a recession because this was so long ago. But I was very I don't know, I don't call it luck, but it changed the way I trade. One of the most formative experience was actually this, which is Citibank. I was working for Citibank prior to this actually. So I was working at one of these like top banks, right, during my internships, during my technical college days. And what happened was that you can see here it dropped about 96%. 96%. Like that concept just is scary. If you had $100 in it, you'd be left with four. That concept just blows my mind every time I think about it. But because I traded during that time, I'm always very weary of the market and very kind of scared of what's going to happen. And if this was my life savings, I wouldn't throw everything in the market. It just doesn't make sense to me. It's too scary. It's better put in safer options. And I'll get into this part. So, oops. Sorry about that. Okay, yeah. So the I was watching this David Wu Unbound, which is another podcast I listen to weekly. He's on YouTube, but he basically says that based on everything that he's seeing, there are not too many places that you can hide during this time because the number best performing is unfortunately cash. That's actually why I have so much cash in my account. If you guys look at this, most of my assets right now in cash. I can show you my portfolio as well, but I think it's like 30% cash. And people have been asking me why I haven't deployed it or whatever. And that's just basically the reason. I think it's a very scary time in the market. Is it going to continue to be this way? I don't think so. I think there's going to be a correction, but after that, it's going to be great. It's going to be okay. It's going to continue to go up. There are going to be some value sectors that we can rotate into. If you look at Ray Dalio's work again, basically says money printing has an inflationary effect. And the only way to have a deflationary effect is to what you see here, reduce debt, redistribute wealth, and cut spending. So in which form it's going to take, I don't know. I just know that we are approaching inflation right now. And Ray Dalio is he created this thing called the all-weather portfolio, and within that, he's got these 4 quadrants. So within each part of the economy, each part of the cycle, certain asset classes will perform. And what we have seen is really growth cycles, right? And what we've seen is also growth cycles, but not so strong inflation. So what would happen here is where would we be? Yeah. So right now, where would we be is like rising inflation, but falling growth, right? So where we should be is treasury bonds and stocks. But again, like I said, David Wu did say that it's not very good because everything seems to be correlated now. And Ray Dalio's work is really based on historicals. Market is quite different now. The structure of the market is very different now. So we kind of have to adapt. And I do agree with David Wu. It definitely isn't a time to be in bonds. Everything falls at the same time. If you guys look at my portfolio, I have gold. I have 2 gold miners, which I thought were really good hedges for this kind of environment. It's turned out to be absolute crap. I think both have been down like 20%. So I didn't foresee that, but good thing I didn't have everything in there. If not, I would my eyebrows like just blown right off. So I'm probably gonna close those in the coming weeks because I stopped seeing gold as a good inflation hedge. Bitcoin is not a good inflation hedge. I love crypto, but it's not a good inflation hedge simply because there's a lot of speculation in the market. There's just way too much of it. So it just doesn't work right now. Okay. So yeah, another thing I'm known for is my crypto because I've made quite a decent amount of crypto, and I've continued to sell as the market's rallied. There is let's be honest. There's really no fundamental valuation in crypto. It's really a momentum play. When I bought Ethereum, I think I bought it at like $100, $200. I was like, okay, this is definitely a good buy at this price. But when I did a fundamental evaluation, I don't know if you can call it that, I valued it at like something like $700. So at 400, I started selling half. At 800, I started selling half, and I kept selling. If I knew it was going to reach 4,000, of course I wouldn't have sold. But because I'm so scared of my portfolio dropping, because this is my own money, because I want to keep my profits, I've continued to reduce my risk as it's gone up. And right now, actually, I have very little Ethereum left. I used to have a lot more crypto, but in the last sell-off, I've really sold a lot. Right now, if you look at my portfolio, not much crypto left, except for DOT. My best bet by far is DOT. And I get excited when I talk about this because I'm a tech guy as well. Right? I love tech. So if you guys look at DOT, the reason why I'm so bullish on DOT is really this, right? This is one of the ways you evaluate, what do you call it, money. It's an economic principle. It's a principle. Don't take it too seriously. But basically, it's this MV equals to PY. So what we want is we want to determine the price of potential price of the cryptocurrency, right? What we do know is the supply, and we do know the GDP is also hard to determine. But what we do know about DOT is that they do 2 things, right? They do staking and they do parachain auctions. These both basically restrict the supply of DOT because when you do staking, to unstake it takes 30 days. You can't sell it off a whim. If tomorrow I decide I want to sell DOT, but I'm staking it, I can't. It takes 30 days to unwind. And then in the meantime, you're getting this interest rate. You're getting something like 15, 16%. And parachain auctions are even worse, right? They lock you up for about 2 years. You promise a project, you have something like DOT, then they take it away for 2 years and give it back 2 years later. But in return, you get different coins, of course. So all this reduces the velocity of DOT. It cannot really exchange hands. And that in theory again, should increase the price. And that's great for us. That's kind of what we want. We want kind of something that has velocity like kind of taken out of it. And that's great. That's just kind of what we want to do. Okay, I'm gonna get into I think 2 more ideas that I have right now. These are my big macro ideas. Again, I've already talked about the market, where I see it going. Haven't given much directional thought to it because I'm really day by day. I'm looking at Omicron and I'm thinking, is it serious? Is it not serious? I think it's too early. A lot of people say it's not serious and they're basing off this kind of facts. I think it's just too early to tell. So I'm not going to speculate. It's too hard for me. And I think given our risk reward potential, I mean, we could lose like 1-2% upside, but if this is serious, you're talking about 30% downside. So it's not really worth it. So yeah, I think I talked about markets enough. These are my real specific ideas. So another one I have is green energy versus oil. And don't get me wrong, I recycle every day. I have a recycling bin downstairs. I make it a point to do that. I bring around a water bottle so I don't buy plastic bottles. I'm all for the environment. But there comes to a point where it's like, when does it become a bit silly? Uh, what I mean by a bit silly is, we still need oil to survive. We're not going to change overnight. In Singapore, I myself, we change cars pretty frequently because we have something called COE. But even then, I recently sold my car, which was 14 years old. And I will never buy a new car simply because it's too expensive and doesn't make sense. I don't know if you guys feel the same way, but it just doesn't make sense to buy a new car in Singapore. So my cars are always secondhand. I'm not going to get a secondhand electric vehicle for a while because electric vehicles haven't really picked up in Singapore yet. So in this transition period, we're really going to be just using oil or petrol or hybrid cars or something in between. And if that's the case, you still need oil to survive. Uh, this is true for the trucks that travel across your supply chain trucks. This is true for all tankers. This is true for a lot of things. But everybody's jumped so far on the EV bandwagon that it's very, very hard to see the impacts. I listened to the podcast on Macro Voices. This was called Greenflation. It could be Macro Voices or it might have been Market Huddle, one of those. They talked about greenflation, which means that because of this green movement, there's going to be an increase in prices generally, in prices of cars, prices of travel, because the oil companies are basically not receiving money. Even though the oil price is going up, in theory, a lot of people in a capitalistic structure, most people should put their assets in there so they can get a higher return. But because of everybody saying, no, we need to go green, these companies have not been able to receive a lot of investments. And you can see this here. So this is the global supply segment, and this is also the amount of investment that's gone into it. You can see there's really been a drop. There's been a drop in the amount of supply in the market. There's been a huge drop in the amount of R&D in the market. So what's probably going to happen is if we have less of a supply, and people are just not getting more out of the ground, we're probably going to have increased prices. Um, and that is why I have energy transfer in my portfolio. And one of my biggest positions is really Chinese oil company, which is state owned as well. And it's really been beaten up pretty badly. Let me show you. This is Sinopec oil. So it's been really beaten up very badly. And I showed this exact same thing the last time I was doing this investor call. And nothing has changed. It's still giving out a great dividend. It's like 9% dividend. And people are basically saying that China's bad, don't invest in China. And for what it's worth, as a Chinese person, because we are very community minded, we always believe in money for everyone, not just money for one person. So because of that, these state-owned enterprises should be better to own because they're owned by the government themselves. And they're giving out a great dividend. There's no reason why they should be trading at these values at 9-10% dividend. I think that's great. Even if it falls some more, I think that's fine because you're still getting more dividends out of it as well. And in times to come, can you really find a company that's giving out great dividends? Answer is probably not. So I'm going to keep this stock for quite a while, I think. Okay, and one of the recent trades I did was equity Commonwealth. The reason why I went into this is a value play. Not that I did mention just now, value investing is not my style. Don't get me wrong, I'm not specifically held to one style. That's actually what I mean. If I see a good value play, I will buy it. So this is a great example of a value play. Equity Commonwealth, equally good answer, question of a value play. Reason being is it's trading at great price to book ratio, meaning that it's trading, at the time I bought it, it was, I think it still is, for every $1 that you buy of the stock, you have 1.02 of assets. Equity Commonwealth has really very, very little in terms of liabilities. This is kind of the balance sheet that I put up recently. So you can see the liabilities basically nothing. So no loans, none of that sort, but they have a lot of cash and they have a lot of buildings. Well, not that much buildings, but some buildings. And I like where the buildings are at. You're looking at Denver, you're looking at Washington, you're looking at I really like Austin, Texas. So I think this is places that are coming up. So because of that, I have a lot of cash and a lot of land that I think is going to appreciate. So I really like this company because of that. And also it's run by this guy named Sam Zell. Sam Zell is one of the real old school investors that became very famous for property investments. So I really like him as well. So that's why I'm in this play. they did an acquisition. They tried to do an acquisition that kind of failed. So I think yesterday they announced they're going to do like this share buyback, which is great. So we made a little bit. I'm hoping we're going to make a little bit of that, but I don't know for sure. But if not, this is a very, very safe asset. The beta of this, or the fluctuation against the market, is very, very low. It's like 0.5. So the market goes up 1-2%, it will go up maybe half of that. If it goes down, same thing. It's very, very low beta. And I like it because of that. It's very defensive. Again, I don't like buying very sexy stocks. You probably won't see me buying growth stocks, except for one. I have one on my radar, but I'll tell you guys about it later on. Okay, and the last one I want to share with you guys is Intel. I'm actually quite excited about Intel. I want to go a bit more long into Intel. Um, Again, I'm a nerd, so I like chips and stuff like that. So I don't disagree. AMD is the better chip. It is way, way better. The ARM systems are just better. The chip design is better. They have nanometer systems, which is small, way smaller than Intel. Intel Silver Lake is way outdated. I 100% agree with all that. But having said that, if you look at the P ratio of AMD, it's like 47-48, meaning it's very expensive. Intel's only 9. And for a chip maker that is trying to get, its foothold back to the US, to trying to do more R&D and things like that, I really like the stock because of it. I like it because it's the very boring semiconductor kind of, chip manufacturer, sorry, and it's very boring business, but I really like it because of it. It's kind of boring. So yeah, these are the ones that I really like right now. Okay, and am I in good time? Yeah, I'm in good time. I want to leave a bit more time for questions. I hope that's all right with y'all, because the last time I did this kind of presentation, there were a lot of questions. And if you don't have any questions, I do have something else that I would like to present, but that's just if you have no more questions. But if you do, just please fire away in the chat box or something, and then let's get to it.